to protect homeowners from predatory mortgage lending. He's earned a master's degree at the London School of Economics and a law degree from Columbia University, and we welcome him at this time.
Thank you, Chairman Conyers, Ranking Member Smith, members of the committee. Thank you for this opportunity to address pending legislation to empower bankruptcy courts to modify home mortgages, just as bankruptcy courts already can modify every other kind of secured debt. The mortgage industry treats that peculiarity in the law as if it were brought down from Mount Sinai on stone tablets. But Ms. Lofgren remembers correctly. It was just a sloppy political compromise in the Senate in 1978, and that nonsensical quirk in the law is now responsible for much of the paralysis in our nation's response to the foreclosure crisis. And we are just beginning to see the effects of the foreclosure crisis. The Census Bureau estimated that 69.2% of American families own their own homes in the second quarter of 2004. And 67.9% own their own homes in the third quarter of 2008. That's a fairly slight drop to this point, but the number will go much, much lower. Credit Suisse now estimates that 8.1 million families will lose their homes to foreclosure in the next 4 years, and the number will rise to 10.2, or as many as 10.2 million families if the recession becomes more severe, a frighteningly real possibility. In 2006, about 2.5 million families were underwater or owed more on their mortgages than their homes were worth. Moody's now estimates that 12 million homeowners are underwater, and the number will rise to 14.6 million by the fall if the decline in home values reaches 10%, an additional 10%, as Moody's expects. Homeowners who owe more on their homes than their home is worth are stuck. They can't sell their house to pay off their mortgage. They can't refinance, and they almost certainly can't qualify for any other kind of credit. Even if homeowners can make their current monthly payments, they have no wiggle room if anything goes wrong, if anyone in the family gets seriously ill, or if anyone loses their job, or if they go through a divorce. Foreclosures are contributing to the decline in home values. The decline in home values is contributing to the foreclosure crisis, and both are contributing to the decline in the economy. Vacant foreclosed homes are stigmatizing neighborhoods and pushing down home values, and price to sell foreclosed homes are flooding real estate markets around the country. Half the homes on the market in the Bay Area of California are foreclosures. Families that lose their homes to foreclosure lose their membership in the middle class, probably forever. And almost all middle-class homeowners are seeing their life savings evaporate with the collapse in their home's value. A homeowner who has seen his home decline in value by 20 or 30% is going to be in no hurry to buy a new car. If 10 million families lose their homes to foreclosure in the next 4 years, nothing else we do to revive the economy is going to work. Ms. Waters was correct. Voluntary modifications are not even touching the problem. 3/4 of the voluntary modifications that the industry claims are just payment schedules with no reduction in principal or interest. Half the modifications in November were forbearance agreements that allowed the homeowner to catch up back payments and actually resulted in a higher monthly payment than the original mortgage. If a homeowner defaulted on a lower monthly payment, what are the chances that homeowner can make a higher monthly payment? Industry has one explanation after another for why there are so few real voluntary modifications. But after a while, it all just sounds like the dog ate my homework. One explanation that critics of the financial industry offer is that the industry is facing millions of mortgages in default, but they are paralyzed, consumed by the fear that they are not getting as much as possible out of each homeowner in default. One witness today on the second panel criticizes the legislation, both Mr. Conyers' bill and mine, as one size fits all. Mr. Chairman, members of the committee, with 10 million families facing foreclosure, we can't afford a lot of elaborate, individualized tailoring. We know exactly what will happen in foreclosure, in bankruptcy rather. It may not be in this bill, but there is a wealth of case law. We know exactly what the court will do. It will result in predictable, orderly, sensible modifications. The court will limit the amount of debt secured by the home to the value of the home. Any indebtedness that exceeds the value of the collateral is not really secured by the collateral anyway. And the court would treat that portion of the debt as unsecured, which it really is. The court would then set a term for the mortgage and set an interest rate of prime plus maybe 1%. Those terms make perfect sense. It is what industry should be doing voluntarily already. The legislation does not help homeowners who bought too much house. It does not help homeowners who live beyond their means. It only helps homeowners who can afford their house, but not their mortgage. It does not help speculators. Mortgages on investment property can already be modified in bankruptcy. A year ago, I spent hours, I spent time, and I spent energy refuting each argument by the financial industry against this legislation. Many of you remember those arguments. They said that their lawyers told them the legislation was unconstitutional and would never survive a court challenge. If their lawyers told them that, they need to get some new lawyers. A year ago, many members were reluctant to question the financial services industry. They believed what the financial industry said. After all, the financial industry made 40% of all corporate profits in America in 2007, so those guys must be really smart. If you think that still, go home this weekend and ask the people you represent how much credibility they think the financial industry should still have with Congress. I think Mr. Conyers is right. The vote we had just a short while ago on TARP tells us a great deal, speaks volumes of what Americans now think about the financial industry and the conduct that got us in the mess we're in. We spent a year and a half, a precious year and a half we could not afford to waste on failed efforts to encourage voluntary modifications. We've offered industry carrot after carrot. It is time for a stick. This legislation is a stick. Thank you, Mr. Chairman.
Thank you, Mr. Miller, for your excellent work. Now, Jim Marshall of Georgia is known as a military man. He interrupted his education